Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. New data is showing us that the market right now is pricing in a soft landing scenario. I'm going to show you exactly why that is. Should we believe this stock market optimism, this soft landing, no recession scenario, and what are the downside risks to the market changing its mind and beginning to price in a hard landing as we perhaps begin to see layoffs rise later this year? That is what we are going to be discussing in this video, evaluating what the next big move is going to be on the S&P 500. If you enjoyed this video, don't forget to click on the like button. We relentlessly try to bring you the best news and information on the markets. So if you appreciate the content, make sure to let us know. And of course, subscribe to the channel if you are new here. Now, without further ado, let's get right into it. So this is the chart that really shows us the S&P 500 is currently pricing in a very mild recession, a soft landing scenario. You can see here the black line is leading economic indicators and the red line is the S&P 500. And this is a year-over-year chart. So when the S&P 500 line is above the zero line, it means it's trending higher. It's in a bull market. When it's below the zero line, it's trending lower. It's in a bear market like 2008, like 2000. And you can see the S&P 500 and these leading economic indicators tend to follow each other very closely, with sometimes very brief lags between one or the other. But ultimately, you will always see these lines move together, as the stock market is ultimately a reflection of what is happening or what is going to happen in the economy. So of course, as you see leading economic indicators stay above the zero line in growth territory, positive growth territory, that tends to coincide with periods where the stock market is moving higher, for example, between 2009 and 2021, because you generally had a strong economic outlook throughout that period. Now you can see more recently, look at what's been happening. We've had leading economic indicators move down, yet stocks have been climbing, or at least retracing part of their losses. You can see the S&P 500 right now is at a 0% year-over-year change. It's flat relative to last year. You can see that's absolutely true if you look at where we were around a year ago in May. Yes, the stock market has gone up and down since then, but ultimately we are more or less flat since May of last year. So stocks right now are completely disregarding the weakening economic data that we're currently seeing underneath the surface. Stocks right now are flat year over year. Economic indicators are pointing down. In fact, right now, as we speak, leading economic indicators are telling us that the market should be down around 20% year over year. So if we compare that to a year ago here in May, 20% down from there is even lower than the low we made in October of 2022. Now, as I'm going to show you in just a second, this is not the first time that the S&P 500 diverges from what leading economic indicators are doing, and we can actually study whether or not this signal is likely to hold up very well. Now, let me just remind you that the most reading on leading economic indicators right here, this is from the conference board. This was released on the 20th of April, showing a clear deterioration in leading economic indicators, which is meant to forecast a contraction in GDP growth sometime in the next 6 to 12 months, similar to what we saw in 2000 or 2008, where leading economic indicators anticipated the recession. The next release of this data point will be on the 18th of May, so only a week from now. It is going to be very interesting to see whether we continue to see economic activity decline, or whether we're going to start to see these turn back up and justify the market rally that we've seen more recently despite this weakening economic data. Because the only way that you actually see the market break out here above this price channel and begin to really move higher and begin a bull run, as many people are beginning to talk about right now, the only way that happens is if leading economic indicators begin to point back up and begin to trend higher. This is the only way that the stock market can be in growth territory. You need to see positive economic growth in order for stocks to move higher. That's been the case at least for the past 30 years. So it's not just enough to see leading economic indicators come back to the zero line and then move lower, because that would still mean that we are in contraction territory and that the S&P 500 should be trading down. We really need to see leading economic indicators begin to point higher. Now let's see over the last 30 years here, if we can spot some moments where we've seen the market do something similar to what's happening right now, and that is front run strong economic growth or stronger than expected economic growth before it actually happens, and whether that tends to be successful or not. And I have quite a few examples to take a look at this chart. We'll start off with the successful examples, because I think that's very important to keep in mind that yes, the stock market can be right about forecasting positive economic growth. You can see here in 2016, you had the market move up on a year-over-year basis very rapidly here. And this was actually this move higher, a very strong move in the stock market, while leading economic indicators were still hovering around 0% growth. So this was really a moment where the stock market was front running growth, and it ended up being right, because you can see growth actually picked up after that moment. And you can see something very similar happened here in 2012. Stock market front running positive economic growth as you have leading economic indicators that are pointing down, and that happens right before leading economic indicators actually do begin to point higher. That was this run right here, very strong move higher in the market at a moment in time where the economy was actually struggling a lot. So people were looking at this rally wondering what was going on, why were stocks moving higher when leading economic indicators were pointing down. People were talking about back here a double dip recession, basically a continuation of the financial crisis. But no, stocks got it right and anticipated an economic recovery. Now, one more successful example would be 1996. Leading economic indicators are pointing down, while the stock market was saying, nope, we're going higher because growth is going to recover. And look at what happened very shortly after. Of course, leading economic indicators began to move higher and catch up with the stock market. So these are all examples where the market got it right, and eventually the economy caught up to justify the gains that we saw in the S&P 500, but there are examples where that's not the case. In fact, looking at this chart, you notice that the market tends to always be very optimistic about the future growth outlook. And let me just start out with this very basic, a very obvious example of 2007 here. Stocks were moving higher towards the end of 2007 very aggressively, anticipating, just like they did here in 2016, just like they did here in 2012, front running a soft landing scenario. That was what was happening in 2007, which of course did not play out, and you had to see the stock market retrace. You can see this is that period where the market was really front running a very positive economic scenario, despite the fact that the economy was already deteriorating here leading up to the top. And of course, the S&P 500 had to retrace very quickly all the gains that it saw throughout that period, and then only started to price in the actual financial crisis that was happening. So this first part of the bear market here in 2008 was just basically retracing this move here that was unjustified by the underlying economy. We actually also saw that in 1999 here. You can see stocks were front-running very strong growth, expecting economic indicators to move up very high here, which did not materialize. You only had a slight bounce in economic indicators before the economy actually entered a recession. So here in 1999, very similar scenario to 2007. You had the stock market in 1999 very optimistic about growth in the near future, expecting the economy to re-strengthen here. That's why stocks were rallying throughout that period. But as the economy continued to deteriorate, the stock market had to adjust to the reality of the economy. Now, I'm going to give you one more example where you had that type of speculative move in the market, and that was actually 2019 here. In 2019, especially the second half of 2019, you had the stock market go on a melt up here. And that was actually a moment of time in 2019 where leading economic indicators were going down. You can see market moving higher, leading economic indicators moving lower. Big speculative move in the market here. Now, of course, when COVID hit and you actually did see a recession, all of those gains were retraced. So there's a few conclusions to make in this video. First of all, the market is clearly being optimistic here over the past couple of months relative to what's been happening in the economy. For the rally to continue and to be really justified by underlying fundamentals, you really need to see leading economic indicators begin to move higher substantially And of course, we'll be watching that very closely over the next few months to see if that happens. There's a lot of work to do on the economic side before we actually see a stock market that's reflecting reality. Now, another big takeaway is that these types of dislocations in the market, like we saw, for example, between the end of 2006 here and the end of 2007, that rally in the stock market in 2007 lasted almost a year, a period during which you actually did see leading economic indicators continue to point down. So the market can be irrational for quite some time, right? This is a 1 year period, over a 1 year rally here, as you had the economy deteriorate, just not enough for the market to really become very worried. But if I have to add my opinion, how we're thinking about this at gameoftrades.net, it is that the stock market is overvalued relative to what's happening in the economy right now. It makes it much more difficult to imagine that stocks are going to break out here in a very sustained move, especially if we do head into a recession. If we are heading into a recession, leading economic indicators could actually have more downside. And so in that scenario, not only does the market need to retrace the gains that we've seen on this rally right here, but it also needs to price in the contraction in the economy that will actually play out during the recession, a little bit similar to 2008. Of course, not necessarily seeing a full-blown financial crisis, but this kind of setup where the market needs to not only retrace gains, but also price in the recession is entirely possible. And in that scenario, you can see it's entirely possible that we see the S&P 500 on a year-over-year basis decline by around 20-30%. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and of course subscribe to the channel if you haven't already. Now in the meantime, I wish you good luck on your trading and see you next time.